Hey everybody, this is Dalton Grados with Grados Capital coming to you with a quick video on how I choose a strike price for my options trades. So before we get into that, just a quick background on strike prices and expiration dates. So as far as strike prices go, it's going to depend on your risk tolerance. So basically, without getting too complicated, the closer in the money you get, or if you do get an in the money contract, it's going to be less risk, but also less reward. So when the stock goes down, you're not going to see your contract go down as much, but also the other way too, you're not going to expose yourself to as much profit potential. The further out of the money you get, higher risk, but also higher reward. So you're going to want to keep that in mind when you're placing your options trades. The other thing is expiration dates. So I typically like to day trade or swing trade stocks, and typically when I'm swing trading, it's going to be no longer than a week really. So my expiration dates are going to be expiring usually the week of or the following week. If you're buying further out expiration dates, say several months or even a year out, you might get much further out of the money because you're giving yourself a lot of time. You might expect that stock to go up $50, even $100 by the time you're planning to sell that contract. So it's going to vary for everyone, but I'm going to show you the different indicators I'm looking at when I'm picking an option contract. So let's go ahead and go to the on-demand here. All right, so here we have the options chain. I have my on-demand on September 2nd, okay? And let's just say, for example, I want to buy a call on Apple. So I'm going to go to my options trade. By the way, guys, I'm using TD Ameritrade's Thinkorswim platform. So that's what I'm using. It might look different for you. And let's say I want to go buy an option for expiring September 11th. So obviously these strike prices that are highlighted in purple are going to be in the money contracts, and these not highlighted are going to be out of the money. Now on TD Ameritrade, you're going to see here on the layout section, this is very important here because this is what I'm looking at. The layout, it's probably going to be default set at the last price and net change. You can set it to be the Greeks, delta, gamma, theta, vega, implied volatility, volume, and open interest. What I did is I went down here to customize, and you can take these notes down. This is my custom setting. So I'm looking at the delta and the theta. Those are Greeks. If you guys don't know what Greeks are, I'll make another video on that. But I'm looking at the delta, the theta, the implied volatility, the open interest, the volume, and the last price. Got that? So when I customize my layout, that's what these numbers are showing here. I have my delta, my theta, my implied volatility, my open interest, volume, and last price. And then you have the bid and the ask here. So what I'm going to look at, I'm factoring in all of these. I like to buy out of the money, but they're also expiring in the next. So if this were September 2nd, these are going to expire September 11th. So I want to get out of the money, but I don't want to get way too far out of the money because, you see down here, these are basically, a delta of 1 and 2. We don't want that. So I'm looking kind of in the middle here on the out of the money contracts. And what I'm doing here is I'm looking at implied volatility, and really what influences me a lot is the open interest and volume. Okay, so I'm coming over here and I see this right here, strike price of 135. Okay, we have a delta of 30, theta of negative 22. We have our implied volatility is so that changes by the time of day. I currently have this on demand at 11:42 Eastern time. So that's our implied volatility. But look at this open interest and volume, okay? Now compare that to the next couple strike prices around it, right? If I go further out, maybe I want to go further out, I would probably get the 140s because, again, look at the spike in open interest and volume. So the ones, a couple strike prices next to it, it's almost double the open interest and volume there. So, and then again, that's a delta of 21. So I've found, just through my experience, guys, and this is totally just me, just subjective, that really my sweet spot for options contracts have a delta between 20 and 30. Right? It's out of the money, but it's not too far out of the money. And that's where I like to trade. But again, that's just me. But so again, guys, that's basically it. I'm looking at, I have my custom settings here. You can copy. And really, I'm looking out of the money, and then the open interest and volume really help me to narrow down which strike price I actually choose. Now, again, think about this, guys. Think about psychology of investors. Okay, round numbers are typically going to be resistances. So any number that's a 5 or a 0, right, is going to be, so we have our 135 strike, a lot of open interest and volume. We have our we have all these in between, the 136.25, 137, all these, and then we hit the 140s, nice round number there. Again, we get a lot more open interest and volume. So that plays a part of it too. Those nice round numbers are going to be resistances there. So yeah, that's basically what I'm looking at when I'm looking to purchase an options contract and how I choose my strike prices. Thanks for watching, guys, and make sure you leave a like, subscribe, and comment as well. Let me know maybe something I missed or something you like to look at, or if this was helpful to you at all. Definitely, please be sure to let me know, and share with your friends as well. Thanks for watching. Let's get better together.